October means bottoms for markets. Traditionally, September's the worst month. There's only been 9 times in the history of the market that we've seen double-digit losses in October, and that's when we usually wash out. It seems to me that everyone seems to be talking and looking for this capitulation. We talk about ETF selling, we talk about the machines. To us, looking at this is a pretty normal correction, led by small caps, then the high beta, then they took out the tariff-related stuff, then they finally got to the tech stocks. This is really normal and what we believe is very healthy. Now, we don't like it when people lose money, but we needed to kind of take some of the froth and complacency out of the market. We think over the next 3 to 6 months, it's going to be led by tech and financials and industrials on the bounce, and into next year, it's going to be healthcare, financials, technology, still the kind of the cornerstones of the U.S. economy and stock market.
Not taking your 2019 numbers down?
No, in fact,
the earnings?
No, we're not, and we're going to publish our official forecast for 2019 in a couple weeks here, and we still think that earnings are understated, that companies are remain defensive, and they're still so afraid to be wrong they don't want to be right, and that defensive mindset to underpromise, overdeliver is clearly showing up in earnings. The average beat is 9.9%. Numbers over the last 30 days have gone up 150 basis points for the third quarter, but no one's really talking about that, Carl.
Numbers are going up a little bit for next year.
They are, and let's remember, I mean, people were kind of begging for a 10% correction in markets. What happened? We had, well, you're saying I didn't beg it up. People were asking for it last year when it was such a benign year. We've seen financial conditions tighten with rising rates and a Fed that's raising rates and spreads out a little bit, strong dollar. So this is normal. This does not look like the end of the cycle. The U.S. economy will slow into 2019, but growth will be strong enough. We kind of go back to this almost Goldilocks environment. What we've done late cycle is stimulate growth, have a 3.5% GDP print, raise interest rates, tighten financial conditions, and growth will moderate, and U.S. will come back closer to trend, and on we go.
So all those fears about the Federal Reserve hiking into a trade war and potentially peak economic growth and peak earnings?
Well, I think you bring up a good point. So we do need more. I think the 3 biggest risks right now are what's the Federal Reserve going to do? I think the market is slowly bringing down expectations. If the Federal Reserve is really convinced they're going to go 4 times in the next year, well, then we're going to have more worries. I think with inflation where it is, the Fed has the room to back off. The strong dollar, if this dollar stays stubbornly strong and accelerates from here because of trade wars, that could slow the economy.
It goes up every day.
I would say this, though. I would say this. The playbook is back in 1994, we had a really tough year, and then markets broke out in October. I'll never forget it. And from there, we segued into American stocks, big cap stocks. It was the Nifty 50 type era. That's when we came up with the Goldilocks regime. And I think we're headed back there the next few years. And oh, by the way, a strong dollar and rising interest rates mean that the economy is improving and that earnings are improving. We've kind of forgotten that. So I think the next few years is all about U.S. dominance in terms of economic growth and earnings growth in terms of the power with respect to how great companies are in this country.
I remember that era, too. We also were, 6%, 7% interest rates, right?
Yeah, because the Fed had to come in and be very aggressive. And the market was negative, David, if you remember, the entire year up until the last 6 weeks of the year. And then we gripped it and ripped it. And then we all of a sudden we're heading into this era. It wasn't the tech stocks. It was
not yet.
Right. It took 3 years to get going, but it was really these big cap stocks that really that define American companies and growth.
And even in 1998, technology stocks were down something like 20% from July through October, and then ripped through the end of the year and ripped in 1999. So I think we're going to know what the end of the cycle looks like. I think we're going to have the classic signs with leading indicators collapsing. We're going to have an inverted
collapsing,
yield curve.
not going down.
Not
because
going down.
this need of peak earnings and peak growth, we're way overblowing all of that.
Agree.